Okay. Good day, my dear students. In our last class, I gave you the format for trading account. Now, we want to use illustration on how to post the items there. So now, I have a question here, but I will send the question along with the solution you are seeing on the board now. This is Alajeku PLC Limited. Now, you can see on the board, the opening stock is given to you. Then you now add purchases. Purchases plus carriage inwards here. The carriage here is based on the goods purchased, which are brought to the store by the man here, Alajeku. So purchases here plus carriage inwards will give you 121,840. Then you now, some goods earlier purchased here may be returned due to reasons known to Alajeku here. So such goods are deducted. So you can see here, less returns. Returns here is a returns outwards. Goods earlier purchased here now returned back to the supplier. So such goods are deducted. Such goods must be subtracted from the purchases here. So you now subtract these the cost of goods returned, subtract from this, will give you 118,620. Then also some goods may be withdrawn, or here you have goods withdrawn, goods consumed by fire, or goods destroyed by fire. So such goods must be deducted. So you can see here, less goods withdrawn. So when that is done, the cost of goods withdrawn here is 1,850. So such goods are deducted, then we have 116,770. Then you now add this now to the opening stock here. Mind you, the opening stock here, there are the goods available at the beginning of the year. So that's why you have opening stock here. So you now add this to the goods, to what you have here. We give you 140,450. This is called COGAF, cost of goods available for sale. This is the actual goods now which Alajeku has to sell. That's the cost of goods for sale. Now, what I've done here is just due to space. So it could have been written out boldly, cost of goods, but here you have COGAF here, which is 140,450. Then some goods will be left unsold. That's the closing stock here, 30,000 naira. So you now subtract that from the COGAFs here. That will give you cost of goods sold. COGS here means goods actually sold. Mind you, these two are different. This is the cost of goods available for sale. Then after you have sold all the goods remaining at the end of the year is your closing stock, which must be subtracted from your COGAFs. That will give you your COGS, cost of goods sold. That is 110,450. Then on the credit side, mind you, I've just explained the debit side now, up to the COGS here. Then I now move to the credit side. On the credit side here, we have two items here, posted here. We have the sales here, which is 176,000. Then less returns here. The returns there is returns inwards. Goods earlier sold out to your buyers, now returned due to reasons known to them. Now, some goods may be sold out, but eventually some may be returned. So in that case now, we have sales returns, which must be subtracted from the actual sales made. The sales there is the net sales, but here now we have some goods earlier sold out returned. So that must be subtracted. So that will give you, the goods returned here is 2,050 naira. So when such goods are returned, they must be subtracted from the actual sales made. That will give you 173,950. This is the actual sales now made, net sales. But in some questions, some goods may not be returned. So in that case now, in such cases, that's the net sales. But in this case now, when goods are returned, such goods must be subtracted from the sales. So less returns, mind you, this is a returns inwards. The returns here is the returns outwards. The goods earlier purchased here now return back to the suppliers. But in this case now, this is the returns inwards. Goods earlier sold out now returns back to the seller. So in that case, it must be subtracted. So we have 2050 subtracted from 176,000 will give you 173,950. So you now take this. Now, mind you, I said earlier, this is the net sales here. The net sales here now, you now come back here, you now subtract it from the cost of goods sold. When that is done, that will give you the gross profit, which is what you derive when preparing trading accounts. You can see here now that from what we have done now, we have been able to derive our gross profit for Alajeku PLC, which is 63,500 naira. Then, mind you, you have gross profit carried down here, which must be brought down here as gross profit brought down. Then you must also bring out, after subtracting your returns from the sales here, you must bring down the figure here. So these two figures must give you the same thing. That's what is called balancing account. The figures on the debit side and credit side must give you the same figures. So you can see there, on debit side here, we have lastly here 173,950. Then also on the credit side, the same figure. Then you have here also gross profit. Earlier here, you can see it here. Gross profit carried down is now gross profit brought down here. So you can see, and mind you, what I've just done here is preparing trading account only. Trading account. Then this account, as I said earlier, is prepared so as to get our gross profit. This account is prepared only to get the gross profit. Then mind you, in this account now, there are some expenses which we have not even touched at all. That will come up by God's grace in our next class, because what you have just done here now is just buying and selling of the goods. The goods has been bought and sold, with which we have derived our gross profit. So here now, after this now, by God's grace, in the next class now, we now continue with what is called P&L account. But what we have just done now is the trading account. So mind you, any question on, as I said earlier, the question on this illustration will be sent to you alongside with the solution. But the solution is on the board, well explained now. So please be expecting the illustration later. Thank you. God bless you.